The following information relates to Tshabalala traders for the year ended the 28th of February 2022. Note, all the amounts in the trial balance and financial statements are shown in millions of rands. That's very important to keep in mind. In other words, all of these numbers actually have an extra 6 zeros at the end of them. In your answers, you'll see that the columns are also headed with a RM. So it means in reality, you just need to write less, which is quite nice. You can see that you're given an extract from a pre-adjustment trial balance and a bunch of adjustments that still need to be done. And you're then required to prepare the statement of income and calculate the average share price. The average share price, you'll hopefully remember, is quite a simple calculation. You're just looking for the value of the shares over the quantity of shares at that time. It's just like the weighted average inventory valuation calculation. So very easy to remember. Then you're also going to do the note for retained earnings and your statement of financial position. Keep in mind that normally you would be asked the statement of income and a whole lot of notes, simply because you don't have time to do a complete question with notes and the financial statements in their entirety. However, it's also very useful to be able to do the complete statement of financial position, because sometimes it is asked. And in fact, this is the end result. This is where you're trying to go. Notice that the statement of financial position is actually the accounting equation. So if you have a look, you can see assets equals equity and liabilities. And then all you do is you split up the assets into non-current and current. And similarly, you show your equity, and then you split up your liabilities into non-current and current. It really is as simple as that. You can see you've got some information given in here. Given the fact that we need to do a retained earnings note, I hope you realize that that 870 Rand at the end of the year should feed into your actual retained earnings over here. And in fact, you can write it in right now because the retained earnings is given in note 3. Always keep in mind that your notes are simply explanations and calculations explaining the final amounts in the statement of financial position. So the first piece of information that we're given is the fact that we've got ordinary share capital of 400 million shares. If we go to our statement of financial position, we'll want to show that 400 million shares as the 4.4 billion. So in ordinary share capital, you would write 4,400, because remember the million is assumed after that. And what you could also do is just make a little note for yourself that that is 400 million shares, because you might need that when calculating your share value later on. You'll remember when we were doing the general ledger, I pointed out that the margins are a lovely place to put the number of shares. Over here, we don't have quite as much space, but you can do it like this to achieve the exact same results. We're then given tangible assets at cost and tangible assets at their accumulated depreciation. Both of those together will need to be combined because they're going to be shown as part of your tangible assets in the statement of financial position. So we'll show the 3,200 minus the 240 right there as tangible assets in non-current assets. We're then given trading inventory. Trading inventory is a current asset of 200. So over here, we can show 200. We're then given our trade receivables and provision for bad debts. Again, we would want to show those together because they both relate to the same item. So we would show the 320 minus the 51. Now, because the 51 is a provision, and will probably need to be adjusted, I always like to just make a little note above that that is provision so that I know which one it is when I need to use it later. We're then given SARS income tax of 63. Notice that it's in the debit column. That's because this would represent any provisional tax that has actually been paid up until this time. So that 63 is actually a current asset at this point. However, as soon as we add the actual tax assessment for the year, chances are it will go back into a credit balance where we owe SARS. So I usually prefer to show that as a current liability payables by minusing the 63. I'm showing a minus simply to indicate that it is a debit balance at this point. We're then also given employee costs of 500. The cash and cash equivalents is actually already entered, which is why I've ignored it. Employee costs is also given as 500. And you can see it's over here in the statement of income. Again, it has actually already been given. And then we've got dividends. Keep in mind that dividends are like drawings. So you treat them in exactly the same way as drawings. In other words, they are not an expense of the business. So you're not going to show them in the statement of income. Instead, they will reduce equity. So you'll take them to the retained earnings note. Now, that would actually indicate the interim dividend that has been paid. So you would show those over here, as 30. And just for yourself, that usually indicates an interim dividend that has already been paid at that time. We can then see we're given some adjustments that still need to be recorded. We've got 1 month's rent that is due. If 1 month's rent is due, that means that the remainder that we're shown over here is actually going to be the rent for the other 11 months. So if we have a look at the statement of income, this rent expense of 220 is 11 months. So to get 1 month, we'd want to divide it by 11. But because we actually want the entire year, we'll put a 12 on the top. So the 12 is what we are looking for, and the 11 is what we've been given already, which would give us a total of 240. That also means that in effect, what you had to do was you had to say 220 plus 20, the 20 being what is still owing or accrued. So there's actually two different ways that you can show your workings here, but it is important to work out the missing figure of the 20, because that 20 will need to be shown as part of payables. We're then given 15 million rand has been paid for an advertising contract that is running from the 1st of February to the 30th of April. We first need to work out what time period is the 1st of February to the 30th of April. You would obviously use the whole of February because it's the 1st. So you'd use February, March. You would also use the whole of April because it's the 30th. So that gives you 3 months. However, your year end is the 28th of February. So that means 1 month is relevant to the current financial year, but 2 months have been prepaid. So what we need to do is we need to take the 15 million and say 15 million times 2/3 to get 10 million that has been prepaid. We will then take that out of advertising in the statement of income. Sorry, let me just change the color so that you can see exactly where it's coming from. So that would be minus, and if you want, I can show the workings here. So, 15 times 2/3, which gives you the 10. And that 10 that is prepaid would need to be shown as a receivable over here as a current asset. Tangible assets must be depreciated by 10% on cost. We need to use the cost rather than the carrying value, which means we will only use the 3,200. We can ignore the 240. We'll need to create a depreciation expense and we'll calculate it as the 3,200 times the 10%. In other words, we'll have depreciation of 320. In the statement of financial position, we need to also remember to take that 320 out of the tangible assets. The fact that it's bigger than the 240 that's already there simply means that the total accumulated depreciation was smaller than a year's depreciation. So we must have bought those items somewhere during the previous financial year. A physical stock count, stock take, counted stock that had originally cost 195 million. Included in this was trading inventory that had cost 4 million, but can now only be sold to 3 million due to changes in technology. What that means is that there was obsolescence of the stock, and therefore there's been a loss of 1 million if you compare the 4 to the 3, which means that the 195 needs to become 194. If we go to our statement of financial position, you can see that the inventory at the moment is 200. And to get it to the 194 that we want to say minus 6. So that 6 will then be shown in the statement of income as a trading stock deficit. It's always very useful when you're trying to work out the trading stock deficit or surplus to simply take the actual stock take figure and put that in as your final answer, because the stock take figure is what you've got, and that is the actual asset. It is expected that only 280 million will be received from trade receivables. That is telling you that this is the net amount that you expect to get. So we need to now go and have a look at trade receivables and make the net amount 280. If we have a look at trade receivables at the moment, that's what we've got. If we want to take the 320 and turn it into 280 net, you can see that the provision, instead of being 51, needs to be 40, because 320 minus the 40 will give you the 280 that you actually want. To get provision from 51 to 40 means that we need to reduce it by 11. If you are reducing provision by 11, that means that we will have a provision for bad debts adjustment of 11. Be careful to make sure that you show the word adjustment so that you show that you realize this is an income or an expense rather than the actual provision, which is a negative asset. You can show the workings over here as at the moment you want to have your 320 minus the 280, which equals 40, and you compare that to the 51 that's already there. And that's how you get the 11. You can, of course, switch it and say 51 minus the 320 minus 280 and simply put the 51 in front. Either way is fine, as long as you are consistent in using your pluses and minuses. Income tax was calculated at the company tax rate of 28%. That means that if you have a look at the statement of income, we can already make a little note that tax is 28%. Hopefully you would realize the taxation obviously slots in between profit before tax and profit after tax. Now, if the taxation is 28% of the profit before tax, that means profit before tax is 100% and the profit for the year is 72%. Once you've got those figures, you can actually use the 180 that's been given and say times 28 that I'm looking for over the 72 that I was given. And then you'd be able to get the amount of 70 as your tax for the year. And then you could work backwards to see that the profit before tax must have been 250, or you could work out the 250 as the 180 times 100 over 72. We're then also told that this company tax was calculated, and after that, it was determined that an amount of 7 million was still owing to SARS in spite of the provisional tax that had already been paid. If we have to recreate the SARS account, we would see that we had an initial balance of 63 on the debit side. We got that from the information that was given at the beginning. We are now told that afterwards there's a balance of 7. If you work out the missing figure in the middle as the tax, you can easily see that it's 70, which is the amount that we already worked out. So that's perfect. So that means that over here, you can either say plus 70 for the tax, or you could just replace the minus 63 with the new 7, because obviously the 63 and the 70 combined is a balance of 7. A dividend of 20 cents per share was declared on the 25th of February. Since we haven't yet issued any new shares, that means that we will use the 400 million shares that have already been given to us over there, and we'll simply say 400 million shares times the 20 cents per share, and that will give us the amount of the dividend. Keep in mind that dividends are like drawings in a sole trader. They're very similar to the drawings, and you would treat them in the same way. So it's not an expense on the statement of income. So over here, a dividend of 20 cents per share per share was declared on the 25th of February. Since we haven't yet been told about any other shares that have been issued, we will use the 400 million shares information that has already been given to us and take that figure times 20 cents. Dividends are shown as part of the retained earnings because they are not a business expense. You can think of them in a very similar way to drawings. In fact, they are the same as drawings for a sole trader. So they will go here and not in the statement of income. We can calculate the recommended as the 20 cents that we've been told about times the 400 million shares that we know, and that's how we would get a dividend of 80. That is probably the final recommended because that's what we've been told. It was decided to buy back 50 million ordinary shares at 15 Rand each on the 27th of February. Since there were no other shares issued or anything else happening during the year, that means that we can use the original amounts of the 4,400 and the 4 million shares that were given to us over here at the beginning to calculate your average share price. The other way of doing it is just go and have a look. And in fact, I would argue that this is a little bit easier even. Go and have a look over here at what you've got. And now you can see why I put the number of shares in there. That can then be used to calculate your average share price as 4,400 million shares over, sorry, million rand over 400 million shares to get 11 rand per share. Once you've got that, you can then remove that amount from the ordinary share capital. So you would take out 50 million shares at 11 rand each, which is going to give you 550. Now, that 11 rand is not the full 15 rand that you actually paid. The difference of 4 rand would need to come out of retained earnings, and so you would show that here as the repurchase of shares. 50 million shares times the 15 rand that was paid minus the 11 rand that was the average price, which gives you the 4 rand extra that would come out of here. And so the 15 minus 11 is the 4 times the 50 million shares gives you 200 million that would have been paid for that. Once you've done that, you can then do all your adding and subtracting just to finish off the entire question. In the statement of income, you can see that we've got the sales minus cost of sales, gross profit is already given. We only have one income amount, so we can just leave that 11 on its own. The operating expenses is already given as 1,406, and you could then work out the operating profit as 300 from that, simply by going gross profit plus income minus expenses. That's how you get your gross profit. You can then check that it works by seeing that 300 minus the 50 finance costs gives you the 250 that we had already worked out as the profit before tax. In all of the expenses, we just need to make sure that there is a total for each one. Obviously, advertising will come out at 140. Sundry expenses is a missing figure that we don't know, and so we can work that out just now. The depreciation we know is 320. If you then look at all of those numbers, knowing that all the expenses add up to the 1,406, we can then work out 200 as the missing figure over here. That 180 profit for the year must then be taken down to retained earnings. So in the retained earnings account, if it wasn't already given, we could put the 180. That's actually something that we could even have done right at the beginning of the question, if you had realized. Always keep in mind that amount there is going to come from the statement of income. You can then add the dividends together to get 110, but keep in mind that it needs to be in brackets. It's always then a good idea to check that your numbers do work out. Obviously, you would simply add all of these together to get the 870 at the end. The statement of financial position, you can then add your tangible assets and see that your new total would be the 2640. Add that to the financial assets that's already given to get 5440. The current assets, you would see that you've already got the inventory figure in. Trade and other receivables, we know is the 280 plus the 10 advertising, so it's 290. And if you add all of those together, you should end up with 817. You can then take your non-current assets plus your current assets and check that you have got the correct total. Obviously, if you didn't, you know that you've made a mistake somewhere and you could go and look for it. In an exam, if you don't have time, don't spend a lot of time because it could just be one tiny mistake. You can also take that and realize that obviously the equity and the liabilities should equal the total assets. And so the total here needs to be 6257. Your capital and reserves, you've already got your 870 in there. When you take your 4,400 million rand of the original share capital, subtract the buyback of 550, you'll see that your new amount should then be 3850, which gives you a new capital and reserves amount of 4720. And then everything works out. If you take your current liabilities, your trade and other payables, you would see that your end result should be 417, and together with the 1120 of the loan, you'll see that again, current equity, the equity amount, the non-current liabilities and the current liabilities together should equal the total equity and liabilities. And then you're done.